Hello everyone, Kolonji Murray with TaxAssurances. Just want to do a helpful video around IRA contributions and tax returns. So quite frequently during the tax season, I will come across people that, they've got a regular 9-to-5 job. They may be, doing investments in an outside brokerage account where they're trading municipal bonds or, individual stocks or even mutual funds, and they maybe have children and they may have a home, and they've got all these other variables that are going on. And they're looking for extra tax deductions or extra tax benefits that they can kind of take advantage of when it comes to, tax filings. And quite frequently they say, hey, look, I've heard this thing about contributing to my retirement account and being able to take a deduction on that. So I just want to kind of walk through the difference between the traditional IRA and the Roth IRA. So the traditional IRA works this way. So you have a certain amount that you can contribute every year. And there are certain, every year they kind of change the amount that you can contribute. There are also sometimes limits on how much you can take as a deduction. If you've got too much income, you may not even be able to take that deduction. But putting that aside, and we can discuss the specifics individually. But the way it would work is, on the traditional IRA, you were able to take that deduction during that particular year. So as long as you have made the contribution to the brokerage account, as long as it's reflected on a brokerage statement, you're able to take that deduction. You have up until the April 15 deadline to actually make that contribution. Now they may change that, I doubt it, but there's always the possibility in the future that they could change it. But for now, you're able to make that contribution for the year up until the tax filing deadline. So that's the traditional IRA. The other IRA, which is the Roth IRA, when you make contributions to that, you're not able to take deductions in that particular year. So let's say, for instance, you put in $5,000 and you contribute again to that Roth IRA. Again, you're not able to make the deduction on your tax return along with everything else we went over. However, the way that it works is any growth, so you're putting in that $5,000, but any growth that occurs in that retirement account, in that Roth retirement account, as long as you take it out, I believe after 5 years, and again, they may change that over time, but the growth that occurs in that account, when you do go to take that out, that is not taxed. So that's the tax benefit there. So different people at different at different stages of age in their life may make decisions in terms of, do I make the contribution to the traditional or do I make the contribution to the Roth, based on when the expectation is that they're going to take the money out. So again, that's just a brief overview of the difference between the traditional and the Roth. Obviously, sitting down with someone like me, being able to go over the details, individual circumstances, can provide further clarity. But again, just recognizing that traditional, you can take the deduction this year. With the Roth, you can't, but the Roth grows in a tax-free way. If you've got more questions, again, love to talk with you, be available to talk with you, and talk to you soon.